shots fired right over the bow at the Midwest multifamily investment thesis. Trepp put out a report last week saying essentially the Midwest multifamily thesis, well, it's a mirage, and that the safe haven trade that so many investors have been getting into the last year or so, or great capital have been doing for the last decade, it's a little bit more complicated than the headline suggests. So we're going to dig into that piece, give you our perspective, but also we got some reports and articles from across the multifamily and economic world. Chandan Economics put out a great report, an update for multifamily right where we are in July of 2026. We've got other pieces, realtor.com, taking a look at the single family world, which markets are hot, which markets are cold, which are really buyers markets, which ones are sellers markets, and also a major policy shift limiting institutions' ability to invest in single family rentals, and there is a mad dash to the exit. So, how is that impacting the housing market, single family rentals, single family homes, but also where we're really focused here on the Gray Report is the multifamily market? How does it all tie in? You're going to want to stick around for the entire episode. Subscribe to the Gray Capital YouTube channel to keep getting videos just like this. Strap in. We've got a great episode. Let's get into it. All right, welcome back to the report. Griffin, I'm reporting obviously on location here at the southern headquarters of Gray Capital down here in the Florida Keys. Griffin's back in Indianapolis at the primary Gray Capital HQ. Griffin, everything going well? Nothing's burned down while I've been gone?
Nothing is burned down. You didn't leave me in charge, so I can't take any credit for the lack of smoke. But yeah, everything's operating just fine here at corporate headquarters in Indianapolis. I would imagine that the weather is quite hot down there in the southernmost points of the United States.
Yeah.
Here in Indy, we finally got a reprieve. Spencer, you're missing out on, I think, some of the best weather in this summer, but I hope you're enjoying being a part of the family down there in Key West.
Yeah, no, I love Midwestern and Indiana summers. I'm conflicted. It is hot down here in the Florida Keys, but the breeze is nice, and I'm here for mostly fishing, diving, and still doing work at Gray Capital. And so when you're on the water, it's actually pretty nice.
What
Awesome.
what you guys don't
Yeah,
have down there, Spencer, is smoke in the air. We have had a
that's what
couple
I've
of
heard.
days where
Yeah.
the Canadian wildfire smoke has just kind of
Uh-huh.
infiltrated in Chicago on Monday, Tuesday this week. It was people out there again wearing masks. Just the air quality
Yeah.
super low. So we finally got some clear skies, which is good. But you're missing out on the smoky weather.
Darn, damn. Well, okay.
Bummer.
Well, I don't know. I'm missing out on maybe the forest fires and some of the smoke from the Canadian wildfires, but we do have a new threat of potential Cuban drones being fired. These Iranian Shahed style drones. Again, it's not actually a serious threat, but down here at Key West, we've got the Key West Naval Air Station and all kinds of surveillance communications equipment down here monitoring Cuba. And so this would be a primary target. A lot of conversations with Cuba. We're talking about this conflict in the Middle East. I jest the smoke's probably way bigger concern. Well, let's talk about multifamily, Griffin. And while we're talking about the Sun Belt, like down here in Florida, which has been a popular investment spot for institutional investors, retail investors, syndicators, as well as Texas and markets like Austin, Dallas, but also maybe markets in Arizona like Phoenix and elsewhere. The narrative has been shifted over the last couple of years of where, while the Sun Belt has seen incredible amount of population growth and job growth, it's seen so much new inventory. And as the supply squeeze is unfolding before our eyes, we're seeing rents decline for multiple years in the Sun Belt. Operators really struggling to stay afoot. And the Midwest has been emerging as a real bastion of safety, or at least the perception of most investors. And it's been part of Great Capital's investment thesis for over a decade. I mean, we're based out of Indianapolis, so part of it is we just want to invest in what we know. And the Midwest has been historically a very steady Eddie market. It doesn't see the big booms, but it also misses out on the bust. So, like back in the great financial crisis, going back to 2008, we didn't see the type of distress that other markets saw. Sure, like it wasn't good for the real estate market, but it wasn't a bloodbath. COVID same thing. The economy was very stable in the Midwest. Indianapolis, for example, had the second least amount of job losses of any major metro in the entire country. And while many multifamily markets have experienced some negative rent growth in the last couple of years relative to supply, most Midwestern markets have been growing, really standing out, and have been the home of some of the top rent growth in the country. Now, while some coastal markets have recently emerged as top ranked growth leaders after years of decline, such as San Francisco and New York City, the question is that institutions are asking is the Midwest investment thesis, is it really all there? If all these new jobs are coming online, is this a complete shift to the narrative of the Midwest being kind of a sleepy but steady market to a real market with some growth potential that has been underserved by institutional capital over the last several decades? And does the Sun Belt um, possess just too much risk to be taken as seriously as it once was? Well, Trepp put out this piece recently that really suggested that the Midwest investment thesis is a mirage and that the Sun Belt is going to be having um, better overall returns over the next 5 to 7 years. The main thesis, and Griffin, you sent this to me. I want to get your input here in just a second. But his thesis is, and this is from Lonnie Hendry, the chief product officer of Trepp. The main thesis is the Midwest looks compelling precisely because it has never been tested by full scale institutional investment. And markets that haven't been stress tested at scale tend to surprise investors on the downside when the capital finally arrives. The Sun Belt, despite its current turbulence, is a fundamentally better long term bet for institutional multifamily capital, and the data supports that view. Now, one of the main primary reasons Lonnie is pushing is essentially the Midwest is untested from an institutional standpoint of an injection of institutional capital, and that the stressors and the risks are pretty similar, and the Sun Belt has more potential for higher return. He goes on later and said, at its core, and I'm quoting, at its core, this is a return argument. For equity capital underwriting to 5 to 7 year hold, the Sun Belt is the better risk adjusted bet, and the Midwest's current edge is a relative pricing artifact that institutional inflows will compete away. And he says the data supports it. But does it? And Griffin, you sent this over to me. And again, to me, the biggest, I guess, takeaway is the fact that the Midwest is even being written up as a potential target for institutional investment when for decades the Midwest has been absolutely ignored. And so now they're saying, look, now all the institutions are going to flood into the Midwest. Pump your brakes, guys. Don't rush into the Midwest. The fact that it's even being considered is a story in of itself. What was your take? What do you think, Griffin? I mean, are we wrong on this Midwest narrative? And it's just this is our backyard. We've got some home country bias. Is the Sun Belt still the tried and true safe bet for multifamily? What do you think?
Here's the message that I think that I would like to push home, and you and I both know this, and I think our listeners also know this, is that real estate remains, a hyper local in its markets, and as you expand and want to get into regions, all of a sudden now you bring in different outliers, and so collectively together, the Midwest has, long been that steady Eddie market. We've been a national front runner in rent growth for years and years and years. We've got markets that haven't seen negative rent growth, in an immense amount of quarters over quarter, and just annual progressive, prolonged compounding momentum. And I think it's honestly, it's a little bit refreshing to see somebody kind of challenge, our narrative and our investment thesis. I just don't understand, essentially as you look at a lot of the headlines currently, we're in the data every week, just as this individual from Trepp would be. I just don't understand how you could say, that the risk in the Sun Belt is less meaningful, or would be, maybe more worth your time to invest in the Sun Belt relative to the Midwest. Now, everybody needs their diversifiers and their buckets, and wouldn't say put all your eggs in one basket and just go dump your money all in the Midwest. Obviously, we think it's a great region. We think the markets are wonderful, the fundamentals and the growth is there. But if you take a look at the Sun Belt, and we've had this conversation with LPs week over week, month over month through our fundraising, LPs that are invested in the Sun Belt right now are hurting. they actually have a bad taste in their mouth for the asset class because of their experience in the Sun Belt. So why there has been, obviously ebbs and flows of market cycles. And this gentleman is talking about, hey, the Midwest hasn't been truly tested through, a down market. I think that's unfair. We've been a part of the same U.S. economy. The Sun Belt's been a part of. We've been the same, a part of the exact same amount of, I would say, what do you call that? Political economic, stressors that the Sun Belt's been through. What we have established here in the Midwest is just something that the highs are not too high and the lows are not too low. And so I think if you want to come in and ride this very steady eddy compounding growth with us, that's awesome. We'd welcome you aboard. But if you want to go chasing yield and chasing upside, the Sun Belt can be where you want to invest. So
I disagree. I don't think that you're going to get any yield in the Sun Belt. I think
sure.
you're going to. I think you're. I mean, there's no rent growth in the Sun Belt, and that's Lonnie's argument is saying that okay, there's been some negative stories about the Sun Belt, and maybe things aren't great right now, but we're getting ready to turn the tide, and rent growth is going to return. We're going to see growth return to the Sun Belt. The problem is though, we're just not seeing that in the numbers. Just scroll down to the rent growth slides and the cumulative apartment stock growth since 2023 in the Sun Belt versus the Midwest. And we can go back down to the, after this, we'll go down to some of the stress indicators that are Trepp's own numbers. But the reality is there's a narrative out there, and we've talked about it, and it's being pushed more and more by like a lot of the mainstream national multifamily outlets that are inherently biased towards a positive story, positive multifamily story, which probably we are too, although we try to be as transparent as possible. But the narrative is more than just they want multifamily to look good. They're trying to cover themselves and not put too much fear in the market because most of these groups are in the business of selling apartments. Whether it's any of the broker firms,
Mm-hmm.
CBRE, Cushman, Northmark, or the software providers and vendors, their clients are these owners and operators. Whether it's Yardi, RealPage, look through everyone's posts and the narrative. It's all generally positive, even in times when probably a little bit more caution was warranted. And I'm talking about some of the best multifamily forecasters and economists, a lot of people that I have a ton of respect for, but there's typically a more positive narrative. And recently, and where this Trepp piece is coming in, is this narrative that the supply wave is over today, and therefore rent growth is tomorrow. And
Hmm.
that's not true. And that's dishonest. And I think we should look back over the last year and a half, 2 years, and say that's not what has taken place. It's not like supply is delivered, those units are 100% absorbed the next day, and then rent growth starts taking off. No, what
Hmm.
happens is more competition is brought into the market. That means rents are more competitive, pricing is pushed downward, vacancy is pushed up, and concessions are increased as well. And that takes multiple cycles to unwind, especially those concessions. When you do a lease up and you give away $1,000, $2,000 gift cards or $100 or $200 off per month on renewal, there's so much pressure to give those same perks, or at least some degree of something to get folks to stay. Otherwise, you're going to have a mass exodus, and everyone's going to leave your brand leased up apartment. You went from 92% down to 60%. You can't get a permanent loan. So these are longer term, structural. I'd say medium term. They're not short term. Long term, I think he's got the right argument. And over the next couple of years, there will be some recovery. And to his credit, he's marking that 5 and 7 year mark of a good exit point. I agree. The challenge is you still have to contend with 1 to several years of negative rent growth, a
Hmm.
feature or just a piece of that the Midwest just doesn't have because it's flat to positive and very positive in many metrics. And it's not stopping. Again, yeah, when we look at the cumulative apartment stock growth since 2023, it's off the charts with the Midwest relative to the Sun Belt. It's shocking,
It's a shocking visual.
and it's not like the narrative has shifted, or the reality has shifted in terms of like now the Midwest is getting all these new permits and all these new starts, and the Sun Belt isn't building anything. It's the opposite. The Sun Belt is still delivering at a smaller rate, but still at a very healthy rate in a normal supply scenario, where the Midwest really has dialed it down below its normal
Hmm.
supply levels. So from a medium and long term, from a supply perspective, the Sun Belt is going to have some challenges over that medium term that I think challenges that 5 to 7 year return objective. And certainly, I don't think there's a lot of evidence to say, oh, the Sun Belt is absolutely going to outperform on a relative basis.
There was a some new data released in regards to permits and starts that came out this week. I included it in the newsletter, and you just mentioned a couple minutes ago that the supply cliff is over today. Rent growth starts tomorrow. I would even make the argument that the supply cliff or this pull down of supply, while I think we're expecting it across the next, let's call it 14 to 24 months, there has been an uptick in overall permits for multifamily and single family homes, and so the same markets that we've seen get saturated with supply in the last 2 to 3 years are the same markets that are also leading the way in these permits. And so while there might be this, brief break in supply in the Sun Belt, there's still more supply coming. And so the argument where, this Sun Belt's going to be a safer bet than the Midwest, while we do have supply in the Midwest, I still believe that the fundamentals in the Midwest, with all of the economic growth that we have here, is really hard to look away from relative to the percent of supply being brought to the market based on the existing inventory. And that's what this chart, essentially is showing. And look at how supply constrained the Midwest is. This is a tough chart to argue against.
Yeah. Well, I think you mentioned a good point in terms of like the job growth, and there's job growth in the Sun Belt as well.
Mm-hmm.
But I think and that's what always is gets pointed to as the compelling argument to continue to invest in the Sun Belt, and it is a compelling argument. I think what's different between the narrative of the Midwest and the Sun Belt is the relative change in the growth trajectory of the Midwest and the Sun Belt. And that's where a lot of Sun Belt investors, I think, miss when they look at the Midwest, is they still put it in the category of not just slow growth, but negative growth. And they're like, why would I go to those markets when we have so much job growth going on in Texas or Florida or the Midwest? But the reality is that the reality on the ground is the job growth in the Midwest is incredibly strong, and it is a very different picture in since really kind of the mid 2020s than it was prior to COVID. The amount of manufacturing, advanced manufacturing, the data centers are kind of a blip on the radar, but the infrastructure boom is incredible, just like it's happening in the Sun Belt, but that was already priced in. All that institutional capital was already pricing in massive job growth, massive population growth. And now some of that is slipping, but the narrative in the Midwest is reversing, where net migration to the entire Midwest is actually now positive for the first time. But markets like Kansas, Columbus, and Indianapolis have been positive for many years and have been outperforming. And that's the next piece of where, not to get on line too hard, but where the Trepp report, I think, it's not misleading, but it's selective and cherry picking of the markets that it highlights, and it admits as such to cast the Midwest as a little bit more risky than it may otherwise be. Specifically, and again, in Lonnie's the defense, he absolutely mentions it in the beginning of his piece, basically saying that markets like Indianapolis, Columbus, and Kansas City, there's really not a narrative to argue against. He's like, those markets are incredibly fundamentally sound. What he's bringing up are markets like Akron,
Mm-hmm.
Cleveland, even markets like Detroit, markets that Detroit has some positive things going on for it, but markets that like great capital we've never targeted for all those reasons. It would be like us choosing only focusing on Austin or only focusing on some of the worst submarkets in the Sun Belt as opposed to some of the better ones. Now there are markets in the Sun Belt that are starting to grow slightly, but that's really those are more of the outliers. Just like there are markets in the Midwest that are not growing, those are really more outliers.
I want to ask you about this 6% here, Spencer. Just we always talk about how, especially when we're going out to acquire assets, how the competitive bidding process works here in the Midwest. It's a lot of very similar groups to us that we are well familiar with and intimately familiar with their staff and their teams. We've seen, I think, more recently in the last couple of years, that we're beginning to kind of have to start to compete with, DST buyers or some larger institutional allocators with lower cost of capital. So I think we have seen a more of an increase in institutional interest in Midwest multifamily, specifically in the markets that we target, which are the ones that have, obviously the best fundamentals. With the 6% of being, the share of institutional multifamily ownership, it feels like you would want to get into these markets before the institutions actually catch wind or become in favor. Just because as they begin to enter the market, we obviously know that cap rates start to compress. You begin to have a likely a higher value for your investors. Would you rather invest in markets that have a lower institutional presence, or would you rather invest in markets that have higher institutional presence? And I guess make that argument and maybe give some evidence as to why.
Yeah, it's a lot of it is you buy the rumor and sell the news, and so maybe sometimes you hold the news if you think the news is going to really kind of continue to pan out. But I mean, once the institutions are in a market, there's a de-risking element of that. Now that institutionals have kind of underwritten that market, they're in it. It's kind of gotten their stamp of approval, which is why so many other secondary investors and syndicators have piled into the Sun Belt. They're like, okay, these institutions, they're in Atlanta, of course. Atlanta's a massive market, but they're in markets like us, and they're in these Sun Belt markets. Therefore, let's pile on. That must be the smart money, or it turns into lazy money really quickly that when you just start doing the same thing for decades and decades. So, but what's going to happen is when those institutions do come in, again, so the risk comes down because there's more liquidity. That's where like the risk decreases somewhat, is that there's going to be a buyer and there's a lot of capital flooding to that market, and potentially cap rates are going to come down. But once cap rates kind of settle at a lower place, it's harder to find entry points. Your return threshold goes down because the perceived risk is decreased because of the safety of liquidity. And so you're fine with a lower return because we'll always be able to sell it to Blackstone or KKR. There always will be buyers in this market versus the perception of a lack of liquidity, which has really prevented some investors from entering a market like Indianapolis or even a lot of the secondary markets because
Hmm.
they're saying, who are the buyers here? And since they've never heard of the buyers because maybe Blackstone's not in that market, they're like, well, they see that as there's no liquidity. The reality is, again, we've operated in these markets since inception. There's plenty of liquidity in the Midwest. There's a lot of Midwestern buyers, a lot of regional buyers, a lot of coastal capital, but it's more, family office, syndicators. It's less of the Blackstones. Now they have been coming into markets like Columbus more and more. I mean, the institutions are now starting to get in Columbus, and they're looking for more opportunities. I think Indianapolis is the next stepping stone for those institutions. And what's going to happen? That cap rates don't go up; they compress, and which is where I think that argument is somewhat left out in the Trepp piece. In fact, they're saying almost the opposite: is that institutions, if they come into the Midwest, they might be surprised when they see some of those values expand. But that's not what the data has really been showing us at all. In fact, cap rates have remained more steady. Valuations have been more steady in the Midwest compared to other regions. Griffin, can you go to, I guess, graph four, the cap rate move from cyclical lows? The cap rates in the Midwest are frankly, they're just more stable. Um, and then also, again, the argument that is made is that essentially the Midwest is just as risky. And I'm looking at Trepp's on the credit chart, and the data that is cited is the serious delinquency, which is lagging. Which the Sun Belt in the Midwest are very similar. At about a 3%, just under a 3% rate. But when we look at special servicing, or especially the watch list, which is a leading indicator,
Hmm.
the risk in the Sun Belt is more than double than it is of the Midwest. And so, again, we're looking at some of the lagging serious, issues of, then a lot of these are going to be maybe short-term floating rate loans that are more of a story of interest rate and strategy rather than markets themselves. And this watch list is going to cover, much broader swath of multifamily deals and debt types, and it's a much more of a leading indicator of what could occur. And again, the Sun Belt is more than double the Midwest. So, like, is there more risk in the Midwest? The risk is because it's less known. Um, but that's where you can get your return premium right now, is because, again, we still have an opportunity for cap rate compression combined with some rent growth.
Hmm. Yeah, it makes a lot of sense. And just taking a look at that chart 3 in regards to the lagging versus the leading indicators, there's distress that's occurring across, each and every region and market. And, it's all for, I think, relatively very similar reasons. It's this watch list of all of this oncoming or, fast approaching delinquencies that I think really begins to kind of separate, the sea a little bit, or at least the tides coming down and, who's going to be wearing a swimsuit. It looks like the Midwest in regard to some of this leading, indicators on the watch list. If I saw that, obviously maybe you're a buyer and you're looking to get a great deal on an asset. But if I'm an investor and I'm taking a look at the market and where my money is going to be the most preserved, all of this leading indicating in the watch list in regards to delinquencies in the Sun Belt would be a little bit intimidating to me.
Yeah. I think that, if you're getting into the Sun Belt right now, you should be a little bit intimidated because of the risk. Now, there can be some good strategies because you can find something maybe really at pennies on the dollar, but you're going to have to buy it at a price that allows for multiple years of negative rent growth. And then you're
Hmm.
basically saying, well, I'm going to make a bet that rent growth is going to turn positive in year X, Y, and Z. It's not going to be year two. Is it year three? Is it year two? Is it year four, five? And again, that lack of NOI growth when we have inflation going on is a hard deal to pencil. So the only way to make that work is if you're just buying at an incredibly low price from a very distressed seller. That property
Hmm.
may not be in the best condition. Maybe it is. There are some opportunities in again buying just really extremely distressed properties at just bargains, but those are fewer and far between. Relatively in the Midwest, you're able to find deals still at attractive entry points from a cap rate perspective. I mean, we've got Fairmont, under contract,
Hmm.
getting ready to close. Griffin,
It's above a six
I'd
cap.
have to look at the T1 or T2 now. I mean, it's literally 90. I think it's 98% occupied when we got the last report last week.
Yeah.
And so we're probably now. I haven't done the most recent math, but we were right at a six cap on a 2025 delivered A-class construction, one of the best submarkets in the
Hmm.
country, right down from Intel's fab. I mean, we're buying that at a six cap. It's probably now more than a six cap on a T1 basis. You can go to the Sun Belt and probably buy 2025 construction for like a similar cap rate. And I'm just trying to do the math in my head. What cap rate you would need to buy a similar quality asset, in Austin, for example, to stomach 2 years of negative rent growth of maybe 3%, 4%, call it negative 2% for 2 years,
Hmm.
and then trying to sell it. I mean, that's a hard comparison, and just to be able to get the cash flow that we're able to achieve, again, Fairmont's fully subscribed, so it's not even a deal we're even marketing right now. But Fairmont, we're getting cash on cash returns in the 8% range, like by
Hmm.
year two. Um, and so in Century, our deal in West Lafayette, where Century, West Lafayette has some supply coming online, but we're still getting average cash on cash by year two, and rent growth, is relatively positive in the market rate
Hmm.
segment. So it's I think we're glossing over some of the real just immediate headwinds that the Sun Belt has, and no one is saying that the Sun Belt won't recover eventually. I guess it's probably not going to be as soon as many Sunbelt investors would hope for. And that's the last piece of that I want to end on this topic, Griffin,
Hmm.
before we move on to the Chandan piece and some of the other reports looking at the single family market, is that, and I mentioned a little bit earlier, but we're all biased here towards multifamily. We're a multifamily private equity shop. We manage, we have our own property management firm. Griffin and I, we do this, every single week, and but we're looking at the market on a daily basis, and so we're also, in the business of calling balls and strikes and just being really transparent, because over the long run, that's how we're going to actually bring on more partners, investors, than just by glossing over everything. And it's always been the case. Everyone's always been biased. Multifamily is going to do well, but I just that I think there's a subconscious push from much of the multifamily industry to believe that the Sunbelt recovery is imminent. And that's because so much of the multifamily industry's personal net worth and all of their colleagues are all tied up in Sunbelt investments.
Hmm.
I mean, this Trepp piece, Lonnie, he's from, I believe he's from Texas. He lives in Texas. Trepp is based out of, New York City, where their corporate headquarters is. I imagine if he's in Texas, his colleagues in the multifamily industry are all mostly Texas investors. And
Hmm.
that narrative, that conversation is about supply slowing down, and hopefully we're going to be able to get to a recovery really quickly. Because the alternative of that is people lose a lot of money. People lose their livelihoods. People lose their
Hmm.
jobs. People lose their houses. And that's not a reality anyone wants to really kind of go through. But that's the reality of a lot of these Sunbelt deals right now. And again, so just I think it's important to always be um, look at a lot of sources, be skeptical. There's a lot of really smart folks out here that mean really well. They put out some really good content and information. But I'm just noticing more and more of blinders, and it's starting to feel like Groundhog Day a little bit because it's like, okay, the Sun Belt's going to recover when? When? And you can say that for the national multifamily market also, but
Hmm.
the Sun Belt is just where the pain is really at. So,
Well,
any other closing remarks on that, Griffin? The Trepp piece? Did we miss anything?
no, I don't think so. I think I have a general kind of perspective to share from my time this earlier this week in Chicago at a
Yeah.
alternative investment conference. There's folks there that are running hedge funds, secondaries, tokenized, this and that, and I'm walking around trying to introduce Midwest multifamily. And for the most part, everybody's got this, bright, shiny, there's like a lure in the water, streaming across the conference room, trying to get everybody's attention on what, frontier asset class they've gotten involved in. And then there's me walking around, Midwest multifamily,
Yeah.
8% cash on cash, pretty, I think relative risk return profiles, we're buying core plus assets. And everybody was like, "Oh yeah, man, you guys really have a good model going. I mean, you guys fill a bucket for everybody. Everybody needs Midwest multifamily." And that was kind of just the position of it all. And I was thinking to myself, well, if everybody needs Midwest multifamily, let's go over here and let's set up a meeting for next week. And that would be awesome. But the
Yeah.
problem is I think there's so many people out there right now. And I think when I started this off, I said people are chasing yield and chasing upside. And like you said, if you want to chase yield, don't go to the Sun Belt because there's no rent growth. But I do think there's so many people out there that are trying to find this like strange edge in the world of investing and
Hmm.
putting their money to work. And I think in real estate, there's certain areas to do that. But when you think about real estate in general, it's been around forever. It will remain around forever. It can be quite reliable. Obviously, it goes in cycles. But if you took a look at the ups and downs of each region and their real estate, again, we started the show off with the steadiness of the Midwest and how we've been able to weather the same cycles that other regions have weathered, but we've done it with compounding growth. I think it's just a really tough argument to say that the Midwest is not worth your attention and is not a good place to allocate your funds relative to the Sun Belt. Obviously, timing matters, and obviously, cycles matter, vintages matter. But if you can find somebody like, again, we love to pump our own book a little bit, but it's just what we do. We're Gray Capital, we're Midwest owner operators. If you can find a hyper local sponsor with a hyper specific focus on one asset class in a region that's so steady, why wouldn't that be worth your time? So I think just the general perspective of, hey, real estate's been around for a long time. We're going to be here for a long time. This is one of the more steady regions in the sector. I don't understand, I guess, how this argument can be made that the Midwest would be less attractive than the Sun Belt. So I appreciate the perspective that Lonnie shared, and I actually think it's refreshing that somebody's challenged our investment thesis and our narrative
Absolutely.
in a way that's so published. But at the end of the day, we are very convicted. We have a strong conviction in our markets and our business model. Again, we've been doing it for decades. We'll continue to do it for decades. So I appreciate the opportunity that he's given you to really voice kind of the opposing opinion here on the Gray Report.
Oh,
And
I love it.
I also think
Yeah.
it'll be a really, really fun talking point for weeks, maybe months to come as we have investor calls, continue to go to these conferences. Everybody I talked to at the conference like, oh, Midwest, you guys are just cruising. There's really no peaks and no valleys. It's just a very stable, very proven market. Good for you guys for choosing those markets. And we didn't choose them; we're just born here. So
Yeah.
that
Yeah.
would be my
Yeah.
last takeaway from this: is just the perspective change of how steady Eddie real estate can, or how long lasting and the longevity of real estate. But then in the Midwest, how steady we are. That's it.
Yeah. All right, let's move on to this Chandan piece. National rent growth trends, actually a positive report. We'd like to see it. Again, this summer is supposed to be peak renting season. Last year, if you'll recall, March, we saw kind of March and April, that was kind of like our peak of the season, which is a little bit earlier than normal, then kind of we lost steam. Didn't really see that bump in April or even May this year, but it came a little bit later. This is probably all related to two different really factors. One, obviously, COVID kind of messed up seasonality for a minute, messed up renewal schedules, but then we've got all this new supply that's also, shifting things around a little bit. But so far, a positive June. In fact, using this is from again Chandan Economics Research, measuring using Zillow's Observed Rent Index through June 2026. We really saw a nice bump up on monthly rent growth. Anecdotally, in the Gray Capital portfolio, if you're a Gray Capital investor, you're going to see this on the quarterly report, and especially in July's report going forward. We've seen a nice tick up in occupancy across our portfolio, and actually started to see some decent rent growth in many of our markets as well. And so, just that anecdote just to be confirmed from some of these national numbers. Um, the share of U.S. metros with rising multifamily rents month over month and year over year is rising. I mean, we really need to, if you look at this chart, we really need to see like some strong rent growth post in July and maybe even some continued rent growth to post in August to see like a reversal of this downward trend. But the downward trend, if just looking at the chart, appears to be losing some of its steam and at least stabilizing. And I'm referencing that just I'm seeing, there's been lower highs and there's been lower lows, but really since mid 2025, it's stabilized. The lows aren't as low, and in general, the swings have been narrowing. And so, just from like looking at it's sort of like using applying some technical analysis to looking at national multifamily growth, this is a positive, or it's a potential of a positive trend if we see a breakout of a higher high from the previous high that we saw back at the end of 2025. So we're going to need another strong July, which anecdotally in our portfolio we're seeing it, but we're going to need to see that continue into August as well. Some of this maybe because I think the market is finding its footing on where the rents actually are, and they're pricing those units accordingly, as well as finding the right balance of concessions, vacancy,
Mm-hmm.
and the whole mix. But Griffin, I mean, how do I mean how do you feel? I mean, this is it's a little it's we're seeing the growth. We'll get to which markets we're seeing the growth
Mm-hmm.
in a minute, but it's bifurcated. But there are markets where we're seeing growth, especially in some standout markets that are maybe more recovering, like San Francisco and others.
Yeah, this is an exciting report. We've spoken on the Gray Report week over week for, oh man, it seems like almost 2 years, maybe longer than that, about just the sluggish, if not, decelerating rent growth of the nation. So it's exciting to see a positive print for a national rent report. In the Midwest, we've seen some, I would say also a slowdown in growth, but it's awesome to see that the nation is together collectively producing a positive print. There's obviously our outliers like we always have. I think San Francisco is just like leading the way in like an immense amount. I think it's a double digit charge. And then there's, again, our Sunbelt markets, whether it's Dallas or Houston or, you name a market in the Sunbelt that's obviously seen some, I would say, negative rent growth.
Go to the map, Griffin. Scroll down a little bit and pop up that heat map. Yep, and then zoom in a little bit so folks can see
Yeah,
it.
Austin, Northport, Florida. And that's where I talk about my little brother on here a lot. That's where my little brother used to live. He probably should have stuck around. His would have been getting a great deal. He actually moved to Naples. But so here's the I love these charts, and I think I included one in the newsletter this week where you can view the nation as a whole and see the heat map. And just obviously red here is positive rent growth, blue negative, and your white or beige for Spencer, who's colorblind, is
Thank you.
like relatively flat or slightly positive. But look at the Northeast and the Midwest. It is where growth is happening in regards to rent. I also think it is, again, where we operate. And it's interesting to go piggyback off the conversation we just had and take a look at the Sun Belt. And so when I go to these conferences and I chat with folks that are, allocators looking to put money to work, and or their other owner operators, sponsors, managers, placement, whoever they are, everybody kind of knows the story in multifamily and rent growth. And when you say Midwest, everybody kind of is very good for you in their words to me. And so this is nothing new. I don't think this is anything that should shock and surprise us. But I do love the idea that we have enough white and red on this map to lift all of this blue up for a positive print for the entire nation. What would be in June
Yeah.
of 2026.
Yeah, I mean, again, I think this heat map shows everything. I mean, look at those like bluer colors, the negative rent growth, mostly throughout the Sun Belt. Not that there aren't some positive outliers. I mean, again, you've got Louisiana as one. You got some spots in Oklahoma. You definitely have some growth, but relative to what we're seeing in the Northeast, the Midwest, San Francisco, we're actually seeing growth. And again, so if you look at the top, if you just read the headline of this article, or if you wanted to put some spin in. It's saying, hey, look, no, rents are recovering. Look at that. This is a positive story. And the subtext should be national rent growth is positive despite the declines in the Sun Belt. And
Mm-hmm.
that's what people aren't talking about is that the San Francisco, New York, places like Akron, Ohio, or even Honolulu, or even Boise, Idaho, which has been all over the board since COVID. Those are the numbers that are kind of lifting the rest of the country up. Some of these outliers, like we mentioned, the Midwest is being steady Eddie, continuing to grow, but the Sun Belt is really dragging all of that down. If you excluded the Sun Belt from the national rent growth numbers, it'd be really pretty positive.
Mm-hmm.
But also, pretty positive is like that's not. We're in July. It should be positive. It needs to be positive. Anything other than positive is really, really, really bad. Every year that we've had bad negative rent growth, we've had positive growth in the summer. It's just the negative growth through all the other months has been too much to make up for a little bit of growth in the summer. So, like, yeah, we are positive month to month, and we were slightly positive in May. In June was better, and July is strong, which is good. It is really good, but we have to keep in mind. And again, this article, is keeping us in mind, but just it's good to reference that we're going to start seeing rents slip starting probably at the end of August. Again, it's a seasonal pattern. People are getting into school, they're moving in, and want those decisions made before September. Typically, again, sometimes we can see some bleed through, and the rental season picked up closer to July this year, so maybe things are pushed back. Again, maybe we're kind of sloshing around in terms of like the seasonality, like periods. But again, it's good, but it's not an all clear sign. And the nuance matters. And that's why, that map is important to show. This is not that the whole nation is acting as one. It's really, we've got a very bifurcated and nuanced picture. And this is a time for taking, I think, rifle shots. And if you're going to just pick a region, you certainly wouldn't want to go with the Sun Belt right now. But again, I think there's some really good opportunities, rifle shots in the Sun Belt, and then there's a lot more rifle shot opportunities probably in the Midwest, and there's probably just some market buys in the
Mm-hmm.
Midwest as well, probably like Columbus, Indy, and some of the other markets that we've mentioned.
Let's talk. You had mentioned, obviously summertime. You have start when spring with some peak leasing season, but you begin to see rent growth over the summer, and then we start to have our downtrend into the winter months. In an operator kind of seat, Spencer, what you are on a daily basis, when you're seeing flat to negative rent growth during the months in which you expect to see, positive rent growth for those gains, how, I guess, share with me the concerns about that winter time and how low, maybe that dip could go. And we'd always talk about compounding, positive gains year over year over year. How is it, what's the equation for some of these markets that have seen year over year negative rent growth, quarter over quarter negative rent growth for an extended period of time? How do we pull these markets out of kind of this downward trend to ultimately, obviously it's a supply and demand issue, but as an operator, you see in the peak season when you should see growth, you're seeing flat, stagnant, or negative rent growth. How does your stomach feel?
Well, it's certainly not as good as seeing, really, blockbuster, strong rent growth, in compounding rent growth when you're basically at a point of where you're, two steps back and you need to get at least 2.5 steps forward to make any
Mm-hmm.
forward progress. it's a more difficult operating environment. Again, that's national numbers, not necessarily Midwest, but a lot of our markets have seen some supply come online and provided some challenges. Not as much as some other markets, but there's a couple things. One, it's not just where your rent growth is, it's where your actual net revenue is a function of your vacancy, and then what's your net operating income, and then really what's your free net cash flow. And so again, those are the numbers that are really the most important. But obviously, rent growth and occupancy, are major drivers of those. And one of the reasons why we're probably seeing some less rent growth that but we could be seeing potentially some higher growth in revenue or even some growth in net operating income as some operators, and great capital included, across some of our properties, some of our markets, and some of our unit types have selectively lowered rents and seeing that when occupancy is slipping, when
Hmm.
occupancy slips across a certain threshold, it's a pretty clear indicator that those certain floor plans or that apartment community may be mispriced in the market. And that can occur when you have a lot of supply coming online and there are specials and other operators are moving their price. We're operating in a world now where there's a lot less pricing intelligence from revenue management system based upon competitive pricing data because of the real page and Department of Justice settlement. And so what I'm seeing is a lot of operators mispricing their units, and then in an attempt to kind of find where the market is, having to lower your rents. And so when you lower them to a point of where you actually hit market in terms of you're getting buy signals and people are actually leasing your units, once you start seeing that vacancy number decline and occupancy go up, you start getting more confidence that, okay, now we can start pushing rents. And that's what I think that we're starting to see is that folks they've lowered the rents, they've given away concessions, they found, in a sense, an equilibrium in where the market is to where they now feel like they've got the confidence to maybe start pushing rents. The challenge, though, is that we're at a part of this season of where just naturally you're going to start to see demand decline. And it's not going to be until 2027 that we have an opportunity really to start pushing some of these rents. So, what I'm going to be looking at is probably not as much rent growth, but it's where our vacancy rates are, where occupancy is going, and looking at that as more of an indicator of where rents might be going here in the near medium term.
Yeah, I think that's a great point. We spend a lot of time talking about rent growth on the Gray Report. One, it's just, I think, a sign of the fundamentals in the market. But the other parts of the equation are ultimately very important. So, vacancy rates. What's the vacancy rate? If you're experiencing negative rent growth and you have high vacancy rate, obviously you're trying to buy occupancy at that point. But also we have expense growth. It's kind of
Yeah,
and the inflation
exactly.
prints and expense growth. And so if you have high vacancy rates with decelerating or negative rent growth, but your expenses are going up. This is obviously where all of that distress starts to come from. And so it's just when you can see positive rent growth for during the months of the year when you should see positive rent growth, or you can start to compound that positive rent growth slowly over time. That gives you obviously that operating capacity to make decisions, continue to maintain your asset, have free distributable cash flow for your investors. So when you see that negative rent growth, there's all sorts of other factors that need to come into play that I do think is worth talking about, or at least identifying, because at the end of the day, they all come together to produce the financial health of the asset as well as the physical health of the asset. Because if you don't have, cash on hand, you can't improve your asset or maintain it. All of a sudden, now that asset value goes down to the next buyer. So it's a very mixed equation with lots of variables, and we spend a lot of time talking about rent growth, but there's other things that need to be considered.
Yeah, no, really good points, Griffin. And I think the best point you made is that at the end of the day, it's funny. We are reporting on these higher the inputs, these KPIs. What matters is cash flow and returns to most investors. And obviously, it's all data. It's all you want to take it into synthesize. But what I wish we have very little data on. I mean, we have some like Nick Reef data and some institutional data, but it's where is the cash flow? How are these properties cash flowing? What does NOI growth look like, and what is free cash flow? Which is again, that's a product of not just the property, but it's the debt terms and the operator. But you know again, to just quote the Wu Tang Clan. Cream, cash rules everything around me. Cream, get the money. I mean,
Yeah.
that at the end of the day, cash flow is king overall. It's the lifeblood of every single business, especially real estate, multifamily. And we don't really have any really solid data. But honestly, and I'm curious of what data is out there. Again,
Hmm.
Nick Reef probably has some free cash flow data. You can look at the apartment REITs, the public REITs, but then that's a pretty small portion of the overall market, and I wish we could get that. Really, the only, I guess, proxy would be DSCR reporting on loans. So that gives you an
Yeah.
indication of free cash flow, and we know those DSCRs, especially in regions
Hmm.
um, like the Sun Belt, are pretty weak right now.
Yeah.
Well, now after quoting Wu Tang, what's next, Griffin?
Yeah, well, I want to ask you one question, and then we'll go to the next thing.
Hmm.
Obviously, San Francisco up top,
Yeah, yeah,
8.5% annualized rent growth. What was
yeah.
it the year? What was it the year prior? What might have been a negative 10%.
San Francisco's had a good now. Well, I think 2025 San Francisco had a pretty decent print because again, that's all we got to be careful going off a whole AI workplace
Mhm.
tangent. But San Francisco and Silicon Valley, huge lift. Two reasons: one, return from work from home post COVID, get back to work. Second, obviously AI boom. AI firms hiring up Silicon Valley in the Bay Area, a huge resurgent of hiring just in that market. But
Wow.
if you go back through, just prior to COVID, and especially really COVID through, I want to say 2024, maybe it's 2023, but they had 3 solid years of just the declines were severe. Now they had some. San Francisco had some like crazy rents prior to COVID, so like
Hmm.
it was a bubble that needed some air to come out of it. But these positive rent growth numbers the last year, I think just now they're past break even from they were
Okay.
pre-COVID, and so they are headlines kind of year over year. I'd have to hop on the CoStar real quick to
Yeah.
see kind of the 2019 through today. I don't know.
That was kind of my question of obviously it's good to see them, having some growth and some gains here, but are they still digging themselves out of the hole, that post COVID
I
or,
think they're out of the. I think they're out of the hole. I think
yeah,
they're out of the hole. But again, every other market, Sunbelt and Midwest, experienced 10, 15, 20, 30% rent growth during like a period of
during
time that
that
they
time?
they
Yeah.
had like flat or negative growth on. So
Yeah.
um,
Let's
relative. Well, we should do a study, relative to the Midwest versus the Sun Belt. But
we'll get John and John on the case. I want to jump to the CNBC article that just discusses the mass exit of institutional single family rent,
yeah, yeah,
institutional homeowners. I thought this was kind of intriguing, and it paired well with the Realtor.com article we'll take a look at next. But the Road to Housing Act, obviously, it matriculated its way through our government and the Senate, and all of a sudden, there was a big scare for build to rent. And, potentially this would be an asset class that takes a massive hit. Somehow build to rent has, weathered the storm and it's not going to be as drastically impacted, but there's still a ban on institutional landlords who will be capped at the number of homes that they're able to own. And that new legislation, new law took place earlier this month. And this article basically dives into the numbers of how many homes were for sale from institutional owners back in February versus how many are on the market, which I believe was in June. And it's a pretty, I would say, meaningful uptick, but it's based on this new legislation getting passed through. And I wanted to talk about that, how it impacts the single family home market, and then potentially how it impacts multifamily, if that's okay.
yeah. Let's do it. I have some San Francisco numbers if you want to talk if
Oh,
we want to talk
yeah.
about those before we move on.
Feed me those because that's I'm interested in that. Yeah, let's go there.
Yeah, so I mean the recovery December of 2025. I mean the asking rent per square foot has moved essentially from about 440. Again, this is rent per square foot. It's crazy here. We're used to buck to two
Yeah.
buck $2.50 a square foot. But in San Francisco, back in December 2025, was right around basically a 440 number. Skyrocketed to just under $5 per square foot. So that inflection point really was in December of 2025, but really had experienced. So looking here at San Francisco rent growth, this is CoStar, as many of you can tell, massive rent declines during COVID, during 2020, way more than most other markets. Really, again, most markets, were flat, with maybe some brief declines. They did see some rent growth, in 2022, a little bit more than I thought, but then it really went negative, post, and then it has been growing
Hmm.
since. And again, I mean, they are. This is some really extreme, rent growth that's going on, going back to this daily chart. I mean, this is like up and to the right. That's what we saw in COVID. Now, so it's not only recovered, it
Hmm.
has definitely exceeded. I mean, it was basically 420 prior to COVID. Now it's all the way almost at $5. Anyway, let's move on. We were talking about CNBC. We were talking about CNBC.
Yeah, I think it's worth noting before we start to jump in and take a look at the markets because I'm interested to understand how. I mean, I kind of understand what's going on, but obviously you flood the market with listings. So the listings from February 1st were about 4,100 listings from institutional owners in across the nation. Now it's about 9,500, 9,447 homes, which represents 3.1 billion in total, asset value. So the number of homes on the market owned by institutions has doubled really over the last, let's call it 7 months, maybe 6 months. Just curious as to what your thoughts on the flooding of the market with some of these institutionally owned, previously rental homes are doing to asset or home values. Obviously, more supply, maybe values come down. Does that make home affordability more achievable for young professionals, young families, and or what does that do to, or how do you anticipate that impacting overall rental rates, occupancies, vacancies, our industry in the multifamily space?
I mean, first off, this is classic government intervention that is interfering into a market and having unintended consequences, and we're already starting to see it. It's the government choosing one type of home, one type of person over the other. They're choosing homeowners versus renters in this case. So, in
Hmm.
probably they're not going to achieve any of their goals, and it's probably going to make things less affordable that for the folks that probably need the most help. And so, I mean, the question here is, are we really helping anyone, or are we really going to be hurting, more mom and pop investors, where many single family home investors are finding themselves all of a sudden being called an institution when they may just own some single family rentals. And so, what is this going to do to the single family home market? Is this going to make single family homes more obtainable to individuals? Maybe around the margins, probably not. Again, it may tip the scales, but we already had somewhat of a weak housing market, but surprisingly, kind of maintaining values, even though the demand has been in question, given how high mortgage rates are and just general issues with affordability. And there's been a lot of new supply of single family homes, but they have been maintaining more or less their price. And we can look at the realtor.com piece here in a second to kind of look at where these markets are. And again, a lot of bifurcation depending on which region you're in. With similar to multifamily, the Sun Belt seeing more weakness with more supply than you're seeing in the Midwest. Um, but where this really hurts folks is, these are essentially houses that families who who could not afford to buy a home, which is a lot of people. Again, you have to have tens of thousands, if not hundreds of thousands of dollars in cash as a down payment to buy a home, and then you have to be paying 2 to 3x per month more than a rental. And so what the federal government is basically doing is they're stepping in here and they're saying, we only want these homes to be owned by a certain type of individual that's going to be
Hmm.
using this home and this property in a certain way versus another individual taking that same property and turning it into a home for someone that could not afford to live in that home through home ownership.
Hmm.
And so it is making things less affordable for the people who affordability is a larger issue. And it's going to help a few folks on the margins, maybe declining prices by a couple $1,000s here or there. So it's hardly even curing a symptom. It's really adding an additional, structural challenge to housing in the United States. So I don't really see that this is going to help too many people, and the negative consequences way far outweigh any benefits that I see to the housing market.
Yeah, you answered that question. I think exactly how I expected you to answer is there are renters that were very happy and comfortable with their family in that single family rental. Now it's being sold. They can no longer afford to go out and put that down payment down. So now they need to look for another rental. But we do have small mom and pop, small portfolios of single family rentals. I think a lot of these families will end up, probably moving into a multifamily community where they don't have the same comforts or that same, lifestyle that otherwise they would have had at that single family residence. I don't maybe understand how they even got to this number, but they're establishing an institutional homeowner as somebody that has 350 homes or more. It seems like such an arbitrary or random number to throw a dart at a dartboard. It's a lot of doors to own as a single individual mom and pop shop. But 350,
but it's
it
not
seems
an
low to me.
institution either. It's
Yeah,
not like
correct,
10,000. And again, one multifamily
correct.
property is 300 units. And so it's the equivalent of like owning one apartment building. That's not an institution.
It just doesn't seem an institutional scale to me. It's 350 doors in the single family home. It seemed very randomly selected and almost uneducated. Um, Taking a look at this, and I want to kind of bring my personal life into the podcast, like I love to do. My parents just listed our family home that I grew up in for 20 years. They listed it at a number that they thought was low, and maybe they can entice and kind of dangle a carrot in front of some families that otherwise would come in and potentially go over ask. They had a lot of interest, a lot of showings. They basically ended up getting their asking price exactly, and they came to me asking, what the heck is going on? Why do you think we, basically didn't get an ask or an offer over ask? And I just pulled up Zillow real quickly in Central Indiana, and we're going to go to this next article with Realtor.com, basically saying what's a seller's market and what's a buyer's market. And I think they've got Indianapolis pegged in here as a seller's market currently, but there seems to be a lot of homes in the market right now, specifically on the north side in Carmel, where I was hyper focused, or north side of Indianapolis, where I was hyper focused with them. But I was just kind of talking to them about the number of actual listings relative to the amount of people that are looking to buy a home. And then you narrow that down with your purchase price and your neighborhood, the market, all of those things. But it had kind of walking them through the fundamentals of the housing market and having them understand, why maybe they didn't get the offer they were hoping to get. But if they wanted that offer, they should have listed the house at a certain number. So the Realtor.com market, that's a market clock. It's for Q2, basically going into the top 50 markets in the nation, walking through the fundamentals, total number of houses on the market, buyers, and then coming down to what is, a scale of, or is it a buyer's market or is it a seller's market? I think this is quite interesting, especially for our multifamily LPs, just because it gives a relative understanding of, are people buying homes in these markets? Is it a good time to buy a home in those markets? Or if people are moving there with positive population growth, can we expect, more households, renter households to form? So in Q2, the overall Realtor.com kind of reading across the quarter was that the monthly report hints that all across the spring, most markets are buyer friendly in the second quarter, which I think is interesting. It says fully 70% of the markets favor the buyers right now and are trending in that direction, which is up 52% from last year. So let's just go down and take a look at their clock that they've put together.
Yeah.
And come through and highlight
I
a
do
few
think
of
it's
these.
important, Griffin. I think it's key, and they say in this article, the fragmentation, is
Mhm.
that remains the defining feature of the 2026 housing market. And it's the exact same line, that we had in multifamily. It's just that we're seeing such a different market environment play out depending on where you are. And again, it's not just Sunbelt, Midwest, Northeast. It is largely that. But yeah, let's get into some of these exact markets.
Yeah, and
Um,
I like that they have them color coded. It's helpful as you can see the regions, and then if there's one that
yeah.
you want to hone in on, I'm happy to kind of highlight it. But I found Indianapolis previously when I was looking through this, so I know exactly where it is. We are in this seller's market, which I think
Mhm.
is leading towards balanced. And I guess when you take a look at Indianapolis, and because we have an interest here within our our business of multifamily, when you
I
see a
would have put it in
seller's.
balanced.
Yes, I would almost agree with you. I think feel like it needs to be down probably more in the middle of balanced. The seller's market thing kind of for me when I saw that just in talking with my mom and how her experience when was selling the home. If it was a seller's market, they would have probably been able to get the number that they were hoping for. Now their house did sell in a matter of about 10 to 14 days, so it went
That's
pretty
pretty
quick.
quick. It's pretty quick.
It went pretty quick, but it went for basically at ask, which obviously they were happy with.
Yeah.
But when you see Indianapolis Indianapolis and the seller's market, let's just go off what they're saying, even though you and I maybe more think that it's balanced. What does that mean to you in regards to maybe demand in the market, people, in migration to our market and our state? And then what does that mean to you in regards to our rental housing portfolio here in Indy?
I mean, it's a positive sign. I mean, the fact that there is, even with just because I mean, you and I both know that there's been a good amount of single family inventory added to the north side of Indianapolis and Indianapolis in
Mm-hmm.
general. The fact that we're even maintaining, given the interest rate environment, I think is a pretty positive sign for demand and positive single family demand. Is housing demand, and housing demand is housing demand. So you're going to see that show up in multifamily as well. So, but again, just as we said, though, I think that probably we're shifting towards more balanced. I wonder also, just given your story, I think it's a really good anecdote, and not knowing, all the details of what maybe they could have gotten, in and all the details on the house. But I'm assuming it's not like a starter home, and that's where you're probably going to see like a lot of competitive activity on homes that
Yeah.
are reasonably priced that you still can find in the Midwest. Um, and I know, and so for everything outside of a starter home, say outside of, $500,000 and above, I think that you're seeing much less oxygen up there and probably
Mm-hmm.
less activity.
Mm-hmm.
And so again, I'm making a lot of assumptions, but assuming the house was like outside of a starter home, higher, just a little bit, maybe a little bit nicer. It's in an environment where there are fewer buyers. And so that the fact that it did get asked within 12 to 14 days, I mean, that's definitely not a buyer's market. If they're getting their offer within 2 weeks, it's pretty good.
Yeah, yeah, it's pretty good. Yeah, all your assumptions are correct. I think they're obviously we're happy with. They let go of the house that they raised their three kids in, so it was an emotional thing. But
Yeah.
they were happy. They were happy with the speed and the number that they got for the home. They
It's a
are
lot
down.
best than pricing it low and not getting any off. That's what I thought you were going to say at first. Is like they price it to move, and it's sitting, and then they're having to consider at a deeper
Yeah,
discount.
I think they
That would
definitely
be the wake up. That would be the wake up call that the market's moving in the wrong direction, or one direction.
correct. Yeah, correct. So let's take a look at these cities in the buyers market. Northeast 0, Midwest 0, in the South, 18 markets in the South are buyers markets. You go back up at the clock, it's all this light blue color in South. Buyers market to me means that there's an immense amount of supply with maybe not enough demand, so people are able to scoop up the home that they essentially dream of for a price that meets their budget. When you take a look at this kind of like stark, we call that a bifurcation or kind of this fracturing of our regions. Does this surprise you at all?
No, no. It doesn't. And again, now there are some markets that just that they're always going to be maybe. Well, I don't know. I mean, there's a combination of really demand stories as well as supply stories, and then some, a few markets that are a combination. I
Mm-hmm.
mean, what do I? If let me, I'm going to turn this around, and ask you a question, Griffin. If you had to buy an index of these
Yeah.
markets, housing and housing index
Mm-hmm.
for a medium term hold, these are which basket would you invest in? The um, Virginia Beach, Madison, Kansas City, Indianapolis, Harrisonburg, Sacramento, San Francisco,
Right.
Columbus, Dayton, Boston, Boise. And then again, there's some variety. And the reason why it's interesting because there's some variety in here. You get San Francisco, Sacramento, Boston. So you get some. And this is like a total experiment, but it's like if you had to buy, you get some nice diversity in here. Some gateway markets, San
Right.
Francisco, Boston, a lot of Midwest. You get some mountain markets that I might not be as excited about, like Akron, but Akron is like never any supply there because it's like negative population growth, so maybe you can get some good cash flow. I would
Mm-hmm.
jump into that market,
Yeah.
versus we go to the maybe like the buyer's market, Colorado Springs, Columbia, I don't know, even Lakeland, Miami, New Orleans, Orlando, Palm Bay, Port, Lucia, Sarasota, Tampa. I don't know. These sellers markets seem a little bit more interesting.
Yeah.
Although this balance isn't bad either. I mean, you get Austin and Chicago in there. So two tale of two worlds.
This is this is also a lot of southern markets, and there's just, I mean, I think there's a lot more southern markets that you can, maybe take a look at where people are actually, moving in and out of. Obviously, there's our Midwest markets. There's maybe not as many of those primary and secondary markets. Maybe we have more tertiary markets in the Midwest. I don't know if
Hmm.
that's necessarily true. But you're talking about buying an index. I'm probably up in the cellar or the balanced, and just obviously the diversification of the markets, but also, I think that these are, I think maybe you want to buy an index looking for a lot of growth. Maybe you buy the buyer's market and just hope that you're buying low and you can come and sell high. But I think if you're looking for that instant, you're looking for a little yield with some upside potential and some, good balance and diversification, you get the seller's market or the balanced and loosening market.
Can you go to the realtor just that the map
Yeah,
also just because and
I sure
we should
can.
almost show the rent growth map and then this map as well and just look at the overlaps. I mean, and again, this is so take multifamily story just like we're talking about housing. And again, like housing demand typically is housing demand. And you can see where things are weak and where there are areas of relative strength based upon the regions. The Midwest and the Northeast are areas of strength. Some are stable, some are reemerging, like San Francisco.
Hmm.
And then there's some, flat and weak markets like in Texas, Florida, and much of the Sun Belt. Again, a lot of this is oversupply, but it's the supply is necessarily slowing down, and the job story is kind of it's there, but it's relatively flat and growing. Where the Midwest again, just like the difference and change, and that's where like, these national home builders are not capital isn't flooding into these Midwestern markets to that's necessary to oversupply. There's not enough capital to oversupply. Now, can it get to that point when there's institutional capital? Yeah, I guess we haven't seen that happen just yet. But at least for right now, in the next couple of years, again, there's bifurcation of different regions could not be more pronounced.
I know the last time you guys were in Key West, you guys maybe for entertainment purposes went to some open houses. So you got any open houses on your calendar this week? It looks like it's a
No,
buyer's market down there.
no, Griffin, I'm buying
Just kidding.
Midwestern multifamily right now, not buying
Good.
any Florida real estate. Although it's it's tempting because the price declines are real. And I mean, I can just tell a story. Yeah, I mean, Alex and we were my dad lives down here in Key West full time. He's a Florida resident. He's from Indiana since half his year down here, and we spend a lot of time down here, with him. And so in real estate, always looking at real estate, and we've talked about the idea. Okay, do we get like a vacation rental down here or something? Just so we spend so much time down here and we were touring some houses. This was probably back in February, I want to say February, maybe March, and just to get more, just to really learn more about the market. And realtor was kind of pushing us hard. He really wanted us to make an offer, and almost a little desperate. And we're like, well, we're not. We'll make an offer on something that we was really clear that we think there's a lot of value in. Not just we're not making an emotional decision, but like if there's some clear value, we'll pull the trigger. But it's all it's obviously a lot of cash. And as a real estate sponsor and operator, for me, liquidity is really important to be able to provide
Hmm.
liquidity for loans while at the same time co-investing into all of our deals. And then also, if you look at my personal balance sheet, there's a lot of real estate on it. So it's like I don't necessarily need any more real estate. But anyway, there was a house that was on the water, been great location, for the kids, and so we but the last owner had only owned it for 9 months, and they had bought it. They were trying to sell it for four or $500,000 more than they had bought it for. And I was like, I looked at the broker. I was like, has there been that much appreciation in the Florida Keys? Like, sure, like maybe a little bit, but I was thinking flat, if not maybe slightly negative. And the more research I did, the prices were really starting to slip. And he was like, oh, no, 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 there's appreciation. Right. Okay. Well, we'll basically offer, he's like, well, if we're going to offer, you need to offer more than what they need a net, more than what, they basically want to at least break even on it. I
Hmm.
don't see how that's my problem necessarily. And so we offered, 100 or I mean, 150 or so less than what they paid for it. And they were offended and all this stuff. And,
Yeah.
they trying to counter. And we were like, look, I'm not negotiating against ourselves. This is the only price or less that we would even consider because I don't have to
Hmm.
buy this house. It's the same way I told the broker, I'm like, this is how I buy multifamily. I go, here's the price that I'll pay. And I'll make a lot of offers and very few, maybe one out of 140 or so will work. I was like, this is the
Hmm.
same thing. I was like, and he's like, don't you want to buy it? I'm like, at the right price. Anyway, they came down. At first, they're like, absolutely not. They were offended, and they were like, they wanted us to change your offer. Like, no, we drew a line in the sand. They came back. They kept coming down. Didn't get to our number, and they were like, guys, we're so close. Just pull the trigger. I'm like, we don't have to pull the trigger on anything. We're good. We're just gonna walk. Give us a call if you change your mind. 3 months later, I got a call saying they would you still accept at your price? They'll sell it to you now.
Hmm.
I said, no, no, the price has gone down. The price
Yeah.
has gone down. All the information I've seen of the Florida Keys now in Florida is the price, single family homes are declining in value. And I've got deals I'm working on. My focus is on Midwest multifamily. I'm good for right now.
Hmm.
Yeah. So no, we're not looking at buying any real estate in Florida right now, although there are some buys out there. But again, I'm kind of focused on Midwest multifamily right now. And but we'll see. Maybe after like 10 more deals in a decade, we'll see what happens.
Yeah. You're going to walk back in the office with a couple new set of keys, and you're going to say, "Whoops," "Whoops." That would be
Yeah,
wild.
yeah,
I think that what you're talking about right here, just mentioning that sellers are finally playing ball in response to kind of losing
yeah,
their leverage. There's a quote in here, a stat in here that just says the median metro listing price per square foot is down 2.5%, and price cuts are remaining elevated at roughly 1 in 5 listings. So I think there's some price discovery that's occurring in some of these, I would say, buyers markets or the balanced and loosening markets, to where homes potentially are sitting for longer and the sellers are kind of having to maybe whittle themselves down, if not get whittled down by offers. So it's just kind of interesting to see that happening. I wouldn't be mad if you walked back in the office with some keys. That would be maybe an exciting thing.
we got some closes to get through first,
We
but
sure
yeah.
do. We sure do. Is there anything else in this article relative to the single family housing market and or the institutional single family rental ban that you want to mention?
No,
Okay.
not no, no. That's it. And then the only other thing on the agenda was, I think, maybe talking about. I just wanted to talk about Century for 30 seconds.
Let's do it. You know what I did yesterday is I sent out the webinar to folks that registered.
Yeah.
Will render that baby up real nice, put it into a nice presentation, and I sent it back out with the invite to please share the webinar to those that may be interested and or rewatch it. Let me know what questions you have. But it was the first webinar that I don't think, well, not the first. I wasn't a part of the webinar. You had Blake in here, and we had, I think, what was a healthily attended webinar, and I did follow along periodically with the chat. It seemed like the Century webinar maybe had a healthy amount of engagement from prospective
Yeah.
LPs or existing Gray Capital investors. Can you just kind of break down the webinar and maybe give me your thoughts on how it went?
Yeah, absolutely. Yeah, no, check it out if it's on YouTube. That's awesome.
Mhm.
Well, it was the first time. Usually we've done webinars. The last few have been YouTube lives, just because we thought the accessibility would be the way to go. But this one we did just on Microsoft Teams meeting, and just folks got emailed the link. And that actually worked out a lot better. And I think one of the reasons is just because it's a little bit more intimate and it gave people a little bit more of the all clear to ask some questions. Like when we've done YouTube lives in the past, we won't get that many questions, even though we can have a good amount of
Mhm.
people on the YouTube live itself. So we got a lot of good questions, some hard questions, but Griffin also, and something that we didn't even talk about on the webinar. So this is like new information. We're getting up to we're in the weeds with Century due diligence. We've done most of the due diligence from a physical walk standpoint, inspections and all of that. But the financials are coming through. We're getting updated financials, and things are looking really good. Especially on a year over year basis. The T3. And they were buying on the T12, right? But the T3, which is the trend, the T3 net operating income is 13.3% over the T12. So it's really seeing some positive growth. 7% effective gross income gain, T3 over the T12, 5.8% T3 physical vacancy improvement. So down from 12.5, T12. I had a rough last year. And then the T3 NOI margin is up 52% compared to their T12. So that's really just a really strong projection. Again, we're underwriting really not hardly much any growth in year one. And so I think seeing this improvement is exactly what we want to see. We're assuming their T3 is printing a 5.8% vacancy. We're assuming 9%
Mm-hmm.
in year one. And our going cap rate on the T3 is a 5.77, which gives us some nice positive leverage out of the gate. It's exactly what we want to see. And so check out, if you haven't, take a look at our interactive deal room. Go to dealroom.greatcapitalllc.com. There'll be a link somewhere below. We've added some new features. So if you've been to the deal room already, hop back in because there's some new things that we've added. We're going to keep adding just, again, because we find out more about Century. It's not a static thing. It's not like a deck printed out once and things change. We don't reprint it or something like that, even though we reprint our decks. But we have we have two new sections. One is a due diligence section, which we've taken due diligence reports and files, uploaded them, created data visuals, so you can review what we're actually getting in real time. Can't share like private information like resident names and things like that. So we're not like actually uploading the full rent roll. If you need to see the full rent roll, let us know. But then just some of the demographic report, employer information, it just allows you to go that much more deeper and granular. But even more so than the actual documents we're listing, the way that the deal room is built out is that it takes all of the information that we're ingesting as a firm that we can legally share with investors. It's going into a long archive, a library or a knowledge base of files to then to be able to reference. So we have this chatbot feature. And I think people sometimes look at it and they're like, oh, that's cute. It's a little chatbot feature. It can maybe answer a thing or two. It has a massive database that it is linked to. It's usually going off of a closed loop system of great capital information, but also deep Century diligence and financial
Mm-hmm.
information. So you can go and ask very complicated questions, and it'll give you very thorough answers. Haven't checked it out? Go take a look. The other piece that we added is a market intelligence section. This is doing live scans of reports, news articles that are coming out related to Century, Purdue University, or West Lafayette, from press releases to statements that companies are making, news reports. It's pulling them in. And so we don't want you just to read things that Great Capital produces. We want you to take a look at all the third-party material as well to just to have a full picture of what the West Lafayette market is really like. Again, we have all the market stats, the population growth, employment growth, all like the data is in like our market section, but this is really more market intelligence, giving a lot of the color to what's going on in the market. So whether you've checked it out or not, go take a look. Dealroom.greatcapitalllc.com. When you go there, you can take a look at Century or Fairmont. Fairmont is fully subscribed. No more room. We're getting ready to close. Century, we've got some spaces open. Take a look. That closing is going to be a little bit further out, so we have a little bit of time. But again, slots are not going to remain open forever. So get in touch with Griffin, Blake, Aiden, myself like today, or go on the portal, sign up, do all your stuff online, make it easy for you. Griffin, have you checked out the new stuff, the new features?
I have. I am a massive fan of. I've been calling it the current events section, which is it makes it sound very rudimentary, but I'm a big fan of
That's okay.
the current event section because, like you said, you have access to what Great Capital is providing you. But on this section, you have now access to what the local news, what the local beat writers, anything that's actually happening in Lafayette and West Lafayette that's a current event, that's an economic driver, that's good and or bad, is potentially going to be presented to you in that section. I don't know how we've set the deal room up so where like gathers all this information, but it's pretty all inclusive across all the current events or things that are happening in West Lafayette. It's a really nice touch that we've added. I think it goes a long way just to show that hey, we're open and willing to share anything about the market that we currently are experiencing. Yeah, it's just cool. There's not a lot of other people that would give you access to something that maybe they don't have as much control over as you would think. I have been telling folks when I talk about the interactive deal room I think you did a nice job of, it's not just a cute little chat bot, but I've been telling people to interrogate the chat bot. I mean,
Hmm.
really get in there
Yeah.
and hold some fire to its feet, hold it accountable, because it's not. We didn't train it to give politically correct answers, or we didn't get train it to be a super salesy, only present the positives. It's in there to be authentic and transparent with all the data that Spencer said you already have access to. So get in there and interrogate that thing because it's ready for it.
Griffin, awesome episode. Make sure everyone you're subscribed to the Great Capital YouTube channel so you can get these videos and more. We've got a new video also besides the webinar. George Malumian, who is a real estate developer, investor in Great Capital, but George has just an incredible history of developing retail, different types of commercial real estate, and just a different perspective. He's been a partner in several of our projects here at Great Capital. And I've just had a just awesome conversation with him about his history, how he built just an incredible real estate business, and is mostly, he's investing in his own business, but also he's also investing into different strategies in different regions. Is in the Sun Belt, is actually trying to allocate to the Midwest. So take a look at that YouTube video. It's posted on the Great Capital YouTube channel right now. Thank you for taking your time, your busy day, watching this entire episode of The Gray Report. Looking forward to seeing you on the next week's episode. Talk soon.